episode of Policy and Profits. I'm Antoni Esposito, founder and CEO of Ascalon 6 Capital. I am joined once again by my good friend, EJ Antoni, chief economist at the Heritage Foundation. EJ, my friend, it is the Holy Week. How are you as we head into the Easter weekend?
It is indeed Holy Week, best time of the year for a lot of prayer and reflection. I'm going to, as best I can, take a couple of days off to try to, get away from work and attend to all the spiritual needs there. But my goodness, they are not making it easy for us with everything in the news cycle to try to get away. I'm preaching to the choir here, Antoni, right? With the huge moves that we've seen in whether it's on the equity side, whether it's on the the commodity side. Oil, obviously the big headline, but natural gas is not far behind. It's been incredibly volatile. And with the reduction in supply that we've seen because of the closure of the Strait of Hormuz, we are already seeing, it's scary, but we are already seeing the effects in a lot of major economies around the world. It's not like we're talking about peanuts here, where it's some of the real small economies that are having trouble getting access to energy. We're talking major players, and I think that's going to have some serious ramifications in the weeks and months to come, really, globally, I mean.
Yeah, no, these are real issues. I always laugh once in a while on Bloomberg. There'll be an announcement that Uganda left their their base rate at 18.5%. So I'll laugh and stay in the room. Yeah. Okay, we got to get ready to sell them. Uganda's leaving their rate at 18.5%. But these are real economies. These are major hubs of production, major parts of the business cycle. This is a real thing. So part of the world that's really being squeezed pretty heavily by the Strait of Hormuz and the war, as far as LNG, energy, and chemicals, is Asia. And you were out to this point. You had put out a few different charts. I pulled one up here, which is, I believe, Japan. But you also referenced the Philippines. You referenced China. Specifically, we know, well, most people didn't know how reliant Asia in particular was on Middle Eastern oil. But can you please go through the point here? How badly are they getting squeezed, and how long can they last before we have more of a major issue? And honestly, as we head closer to a global economic recession, because it seems like we are headed that way.
Great question, Antoni. So, as bad as prices are here in the United States, we look at $4 gas and we say, oh man, that's rough, especially for so many Americans that were already living paycheck to paycheck. That is demand destruction territory, where people are starting to make decisions to use less gasoline, right? Prices, if we look at now, that's the situation here in the U.S. You look at the situation in Asia, it's even worse in a lot of countries, whether it's Japan in this case, but also Australia, Philippines. We're seeing a similar situation with Taiwan. There, you're at the point where even though prices have risen even more, it's not creating enough demand destruction to match the reduction in supply. And so those nations are having to dip into their strategic reserve. Here in the US, we're dipping into our strategic reserve, but just because we're trying to lower prices, it's not because we're literally running out of energy. That's what's happening in some of these major Asian economies. And they are just far more dependent on Middle Eastern oil than we are. That's the reality. Look at Japan, 95% of their oil is coming from the Gulf. I mean, that's incredible. And most of that, not all of it, but most of that pipeline has been shut off with the closure of the Strait of Hormuz. Obviously, you have a lot of oil still coming out of the Red Sea, for example, but the Saudis have maxed out their cross-country pipelines there, and they're getting as much as they can out of those ports, and there's nothing more that they can do there. So the blockage in the Strait of Hormuz just is what it is at this point. Until that's cleared up, you're not really going to see an appreciable increase in global production. I think we just don't have a lot of excess capacity. One of the problems that we've faced here at home has been all of the additional costs that were imposed on the oil and gas industry, chiefly by the Biden administration, right? And what happened was, in order to be as profitable as possible and keep pumping at lower and lower prices, drillers became more and more efficient on a per wellhead basis, and the number of wells were reduced. And that reduced our overall capacity and therefore our excess capacity. What I'm getting at here, Anthony, is that yes, we increased production over the last several years, but it was at the expense of increasing total capacity. In other words, our potential production, again, as well count continued to decline. So whether it's the United States, whether it's the Gulf region, whatever the case may be, there's not a lot of excess capacity here to replace the closure of the Strait of Hormuz. And it's having a real effect, right? Again, you are seeing energy usage plummet in a lot of these Asian countries. And that's significant because, again, Asia is, of all the regions in the world, Asia is going to be the most dependent on the Gulf. We obviously are going to be the least dependent because we have so much of our own energy. But what affects those Asian countries first is going to trickle down to the rest of the world, because now all of those Asian countries are trying to buy from other areas around the globe, which is what's putting upward pressure on prices here at home now. This is why you saw that the premium that Brent has over a WTI basically evaporate today, right? WTI is going to catch up to Brent as countries like Japan come knocking on the door of West Texas saying, we'd like to buy.
Yeah. Yeah, that was a great trade. That spread actually was, I saw it almost 6 standard deviations away from the mean, meaning Brent will always trade at a premium to WTI as the global oil contract, but that spread really exploded. So, whoever put that trade on the reversion of the tightening of that spread, white knuckled through it, I'm sure, and made their career, because that was a fantastic trade. It was a fat trade, a lot of risk in it, but that spread has come in and normalized in a matter of a week, which has been an amazing trade to watch. I'm going to shift gears really quick here. Still on crude, still on oil energy cost. We have WTI crude at 111 today. President Trump made his speech last night. I was in front of the computer. I was looking over the portfolio. We had some positions that I was kind of shoring up on the edge. I watched crude go through par, up about 3% to 103, actually go negative at one point. I think we got down to like 97 and change, or 98 handle, and then completely exploded. And we closed the day up. Well, we're trading at 111.75. I don't know where official settlement was, but it was somewhere in here. The question is this: at this point, what is the effect on inflation here in the United States if crude stays at these levels, or what damage has already been done? If crude was to go right now back to 70, what are we looking at as far as inflation for the balance of the year? Can you speak to that at all?
Yeah, absolutely, Anthony. So right now, let's do the best case scenario first, then we'll do worst case scenario, right? Or, well, close to worst case without getting, apocalyptic here. Best case scenario, this all wraps up literally in the next 2 weeks. And we're just bringing military assets home. The strait is open, you name it, right? We don't have to blow up Iranian energy infrastructure. They don't blow up anybody else's. So truly, just what's already baked into the cake. You're going to have a couple of hot 3 handles on the CPI, whether it's we're talking April, May, probably into June and July. Second quarter CPI is probably going to be annualized at least 6%. Maybe hotter. Again, annualized there for second quarter. So you're looking at some hot numbers, and it's because of those initial hits to energy. You're not going to see a big increase though when it comes to core. Where you will see it show up in core is several months down the road. So in the autumn, you're going to see a jump in food prices, because the fertilizer shortages and the higher fertilizer prices that we're seeing today are going to show up as higher food prices again in the autumn when you go to the grocery store. But also because of the fertilizer shortage that we're seeing today, application rates for the next several weeks and months are going to be down, which means your crop yields are going to be lower, which also, again, that reduction in supply puts upward pressure on prices, points to those higher grocery store prices late this year. You're also looking at another knock-on effect when it comes to the plastics industry. And look, plastics are everywhere, right? They're in plastics, components of your cell phone, car parts, computers, synthetic fibers and clothing. I mean, you name it, the plastics that we make from natural gas and oil are literally everywhere. So the higher feedstock components, or higher feedstock prices, I should say, are going to trickle down into these plastic components that are in literally everything. And that's where you really start seeing it in core. But again, for that, you're looking probably 6 months down the road for
Yeah.
core to take the hit. So that's the best case scenario. We have a couple of real hot headline numbers because of energy. Core gets hot late in the year. And then hopefully 2027, everything starts to cool back down. If, however, this just continues dragging on and the initial 2 weeks just keeps turning into another 2 weeks and another 2 weeks, and oil stays at 100, I mean, you're definitely looking at global recession territory, not depression, but you're definitely looking at a contraction in overall economic activity. But unfortunately, it's again paired with those higher prices as well. And this is what happens literally every time the globe has an oil shock. You can go back literally for more than 5 decades, Anthony, right? And this is what you see whenever you have a global energy shock, whether negative or positive. You will see the exact same impact on both overall economic activity, but also prices. What happened during the shale revolution? You had the global economy pick up at the same time prices went in the other direction.
Yeah. This is interesting. Yeah, so definitely more of an inflation shock to come than even I expected, to be perfectly honest with you. That's a good rundown as always. Yeah, if we start seeing CPI hits, CPI numbers that high, and then core CPI numbers that high in the fall, definitely going to have a major effect. Obviously, global recession is an issue, and like you said, it's not going to be a depression, but we are coming out of a market that's been poised to fall. So as far as capital
Right.
markets go, and as far as where the liquidity has found a home, we're going to see some wealth destruction, further wealth destruction, even more than we've seen, which we fully expect. And I'll shift gears here now to the charts. We go to our weekly S&P 500 chart. I think we're on week, I don't know, 7 or 8 or 9 of running through this. And when we started this, we were well within that ascending wedge. Anyone that's been watching knows that in mid-February, early to mid-February, we started putting this chart up. This chart was an ascending wedge. We saw some failure in a negative momentum on the bottom of the chart, which was very similar to what we saw in December of 24. We were seeing the same type of thing December of 25 into January of 26. All-time highs in the cyclically adjusted price to earnings. As I had mentioned before, the only times we've seen that Shiller Cape PE for the S&P 500, 2 times in the last 150 years. That was 1999 into the year 2000. That was the tech bubble. And that was 2025 into 2026. Those were the only 2 readings as far as valuations that we've seen that high. At the same time, we saw a breakdown in momentum. That's a simple indicator at the bottom of the chart. All looked pretty bad. And then we saw this ascending wedge, which we noted in February. We had 2 price targets coming out. We had 6,600 and 6,400. We did achieve both of those price targets during the month of March, which was actually a great month here at Ascalon 6. We were well prepared for that move down. We were well prepared for the move up in crude. We actually had all of the assets that we trade in our universe, and we are a very tight universe. We only have 5 assets here that we trade in the future space. All of them contributed positively to the return for the month. Waiting on those final numbers, but well above 7% for the month here at Ascalon 6. And this was a big part of it. You'll notice as we get down towards that 6,400 level, we have the 100-day moving average at 6,340. We came pretty close to tapping that. I'll count that as a test of the 100-day. We're now back up through 6,600. We're at 6,623 live right now. So both price targets hit to the downside. I expected a run up. I do not think that the sell-off is over. I think that we have more room to the downside to come. There's a tremendous amount of risk as far as what valuations were, as far as rates, as far as the consumer, as far as valuations, as far as the Iranian war, and now inflationary pressures. Stagflation looks like it could be a real thing. So we have a lot going on here, but to stay focused on the market, hit our targets, worked very well. We had an interesting setup, and I'm going to pull up a 30-minute chart, which normally we don't do, but this is part of the trading within the model. So here we have kind of a mantra on the desk. It's model, chart, and stick. Our model is our overriding directional call, and that's which way our quant and our rules tell us the market is headed. And then within that call, we have an alpha wrap where we can make decisions, based on our experience and based on the trading talent on the desk. So we have the model, and then within that, we have the ability to make some calls within the rule set, but we have the ability to make some calls. And this was one of those calls. March 31st, last day of the month, last day of the quarter. I'm going to go into why the rally we saw was picked up. We actually picked up on this, and we ended up long into this rally. Actually started the night before. What I want to say is that there are a lot of structural moves to the market that do not have to do with the investing community believing that all is good. I think a lot of times investors and retail investors in particular see the market rally coming off of a 10% sell-off, and there's a big spike up, and they're like, oh, everything's clear, everything's good, I can jump back in. That is not at all the case. What we're looking at here on the 30-minute chart was what we call positive divergence between the RSI momentum indicator and price. You'll notice that at top, the 30th in the overnight session, so that starts at 6 p.m. Eastern time, you'll notice a double bottom, actually the S&P price making a lower low, a slightly lower low on a double bottom. But you'll notice that the bottoming out on the momentum indicator, the RSI, was actually a higher low. So what this is telling you in emotional terms is, although the market pushed lower on the second tap, it did so with less enthusiasm. It did so with less momentum, meaning it wasn't as happy to make sales lower as it was to make sales slightly higher the day before. That's called positive divergence here, meaning that low, I did not expect that hold to low because of the lack of momentum on the push. With that, we got long the market. There was also a pretty good setup heading into last day of the quarter. Because of the fact that we had taken such a drawdown, because of the fact that we were literally at the lows, we saw positive divergence. We had 30 billion plus in rebalance capital that needed to be put to work by the pension funds in particular. You had a derivative unwind, meaning all of the dealers that sold puts to everyone that bought puts in fear needed to unwind that hedge. Okay, and when the dealer is short a put, and I'll try and be as simple as possible, when the dealer is short a put, they're long delta. That means they had to short stock to get the position on to stay delta neutral and not lose money on that position. And market moves, that means when they unwind that position, i.e. coming in on the 31st, market's moving higher, those puts are now being sold back to the dealer. The dealer needs to buy back that stock. That creates demand. That creates a push up. Again, that's a structural rally. In addition to that, you had a ton of short interest out there. CTAs were all over this thing short. What happens? They need to cover. Their stops go off, and you start to get this snowball effect, what I call a structural move up within a bear market or a bear market rally. And that's exactly what we saw on the 31st. Heading into the first, that was the 31st trade. Heading into the first, I believe there was an extension of that rally because of President Trump's speech last night, which was not as expected. And then I can go into today, which was a phenomenal trading day, but I won't. I just want to point out that we hit both of our targets on that weekly chart, which was spot on, I'm happy to say. And then that structural rally on the 31st was just that. Don't think that we can't have spikes and rallies within a bear market without that being the bottom. This is not capitulation. Capitulation does not occur down 7% or 9% or 10%. Yes, that could be a standard correction, but capitulation in a market will occur down 30%, down 40%, down 50%, down 57%, like in 08-09. And by the way, there were 4 to 5 rallies, 08-09, within that bear, that 57% drawdown, 4 to 5 rallies, which were anywhere between 7% and 25% in magnitude to the upside within that down move.
Wow.
Just be conscious of this. So this is kind of where we stand. We're in a pretty strong position, back above 6,600 now. Interesting turnaround today. Continue to work through the charts and continue to work through the S&P chart, this front month futures chart for the S&P 500. But as of now, just wanted to update on the targets being hit, a bit of a structural rally within what I believe is the beginning of a bear market. And we'll keep an eye on that 30-minute and that the other trading charts that I watch and the weekly chart, and we'll keep everybody up on where we think we're headed. But for now, back above 6,600, and potentially structurally, our model actually shifted to positive today. So there is some room to the upside for the S&P 500 and for the Russell 2000, which are the two equity contracts that we trade.
Love the technical analysis, Anthony. I'm especially grateful that you switched into the, not just the weekly chart, which is always great, but your second one there that really drills down onto, those the tighter time frame, right? Our higher frequency, I guess. Yeah, that was particularly interesting.
Well, thank you very much, EJ. It's always, it's interesting to go from the model. I go both ways, right? Our model runs on a daily timeline, and I move out into a longer term timeline to see a greater trend. And then we move lower into other timelines and other charting to try and determine where we want to be positioned for the trade and how we want to be positioned for the trade within the model call. So that was one chart that I had noticed that, and to be perfectly honest with you, I'm on the 30-minute. I'll check it. It's pretty noisy in my opinion. A lot of people love it. I think it's a little noisy, but it was a good.
You can use it to justify anything after the fact, right? Because it's so noisy.
And that's it for the market. We are definitely. It's the moves have been magnificent, and the tweet risk and the announcement risk and the headline risk is off the charts. So I would say the biggest struggle we have right now is not making a market call or having a view technically on the market, but these random, and we talked about it last time too, these random spikes or these explosive 100, 200 handle moves in the S&P because of a tweet to the upside and the downside. So we'll keep an eye on that. As far as that goes, EJ, thank you so much for the time. Great analysis. And definitely we need to keep an eye on this inflation number. This is going to be a major issue, and it's going to roll into the conversation of rates, and it's going to roll into the conversations of the Fed as Wash takes over. Is there the potential for a rate hike at some point? I don't know.
Yeah, I mean, if we look at what markets are pricing in, they think at the earliest you're going to see a rate cut in December, not till December of this year. And in fact, you're seeing a growing percentage. It's not high yet, but still, it's off of zero. A growing percentage of market participants that are actually pricing in not only no rate cuts this year, but possibly one rate hike.
Yeah, I would say if we get a rate hike, I would say, depending on where we are as far as level in the S&P, that could easily be a very quick 5 to 10% drawdown in the market. That's going to be a shock to this market, depending on how well it's discounted ahead of it happening. But we shall see. At Real EJ Antoni, thank you very much. The handle is awesome. I'm on it every day. I am at CMT_Anthony, but you could reach me at Anthony.Esposito at Ascalon6capital.com. EJ, my friend, be well. I will talk to you soon, and thank you again.
Thank you, Anthony. Blessed Easter to you and yours.
You too.